Hi everyone, 𝗁𝗵𝗶𝗀 here with 𝗁𝗵𝗵𝗶𝗴𝗲.
Good morning, good afternoon, depending on when you're watching this, depending on when this is released. How's it going, everybody?
So we are here today to discuss yet another increase of the overnight lending rate by the Bank of Canada. And I'm going to say a little bit of shock and awe from the Bank of Canada on this one.
A little bit. Jeez.
A lot of people weren't expecting it.
Yeah, a lot of people weren't. Yeah, that's easy to say after something's happened, but I think there was some sort of murmurs that there could possibly be another increase at some point this summer.
Yeah.
Whether that was today or the July announcement, people were not really sure about that, but turns out it was today.
Yeah, today was our lucky day.
Yeah, that's what I would call it, lucky.
So with the increase, another quarter basis point that has been tacked onto the overnight lending rate. That means today's prime rate being at 6.7% is going to be likely moving up with most lenders.
With almost 100% certainty. Usually the banks will react accordingly. Yep.
Yeah. So that will put us at 6.95%.
Yes.
On a basic prime lending rate with most lenders.
That's right.
And that,
I think that's the highest since I came into this whole world in 2007. I think when I came in, prime was in the sixes.
Yep.
So this is now officially higher than I've ever seen it since I've been working in this industry.
Yeah, and I think the people are saying that this is the highest since like 2021 or something like that. Or sorry, since 2001, pardon me.
2001 probably sounds right.
Right? And it's, when you think about it, it's absolutely scary.
It's downright terrifying.
Yeah.
Depending on your situation, but there's no more buffer for people. There's no comfort zone. That discretionary income that a lot of people used to have has just been taken away.
Taken away, yeah, 100%. I would say that this change, this increase, these rates as they are today, kind of remind me a little bit of when I bought like my first home. It was 2006 and rates were kind of, high.
Yeah, here's why I'm upset. Prices aren't the same as they were back then.
Exactly.
Incomes aren't that much more than they were back then. So you've got rates that are, yes, maybe the same as when you bought your first place. You have incomes that, they've adjusted for time that's passed, but not at the rate of these prices, right? So back then you might have been able to buy your first place, I don't know, for $300,000.
Yeah.
Detached or semi-detached home, let's say in 2007-ish, 8?
6, 7, yeah.
Okay, that same home's 1.2 now, 1.2 million.
I know.
Your income might have been, let's say you were making 60 in 2006. That same job, what are you making now? Like 75, 80?
Yeah.
Okay, so $75K to now support
$1.2
$1.2 million price.
Doesn't equate.
Things aren't climbing at the same rate. That's the scary part is for the people that say we've seen higher rates and incomes were lower, but I think just the level of debt Canadians have taken on, that's what makes this particularly frightening. Yeah.
Definitely can be scary times. And, I know we were talking about this a little bit earlier and, what's caused this. And, this is the reason why we're sitting down here today to kind of just go through what's going on and, more importantly, what do we do, right? What's the best next step? And
when you find out, let me know.
Yeah, I know, right? But I think it all comes down to the individual. And I know.
There's no like cookie cutter, one size fits all advice that you would give somebody today. You know, I know that sounds cliche, but really your situation and my situation aren't necessarily the same.
Correct.
So, of course, we're not going to react to something like this in the same way either.
Correct. Yeah.
So for me, the common question now is going to be what we've had throughout this entire year. Like, is it still worth taking this variable ride, or is it worth maybe looking at a fixed rate option? For me, the number one thing is make it about that individual's, I'll call it priority. So what's most important to you? So if you're an individual who's really feeling the cash flow pinch, then the rate is sort of secondary, you know, in that conversation. So yeah, the rate's going to improve if you go fixed, but really it's the payment that individual is really needing relief on at this point. So the first thing is like, what's the priority for you? Maybe if you're still not impacted too much with your cash flow, then maybe payment's not your number one priority, but what is, right? And then again, projections and all these things on where rates are going, everybody has their own
idea
views on what is going to happen there. But the first thing for me is like, don't just ask, where do you think rates are going? Like, first of all, what's your need? What's your priority? Because if you have a cash flow situation right now, then again, rate is secondary.
Yeah. And you know, that's one of the things that I think a lot of people right now are really up against. They're looking at it and saying, okay, my cash flow is being, you know, taken away from me month over month every time the bank meets. And, you know, I see that the variable rates are extremely high, and, you know, eventually rates hopefully come back down. And can I wait to, you know, long enough for those rates to come back down and sustain the cash, you know, the negative cash flow that might be happening, or the cash flow crunch that's happening, versus making the switch to a fixed rate? And, you know, that's probably a very difficult decision to make right now.
I think it's almost impossible to, I think, what was the wording you used? Like, you don't know what's going to happen.
No, you don't know what you don't know.
How do you make a decision without being able to predict the future? I mean, even a lot of the bank economists just a few months ago were making predictions that now appear to be probably off. They're not, you know, rates going down by the end of this year substantially is what some of them were saying. I don't think we're on track for that. No. So how do you make a decision when even the experts can be wrong? It's difficult.
Yeah.
You have to, I think you have to make a decision for today.
You have to make a decision for your individual situation.
Exactly.
You know, and, you know, I was sitting down and thinking about all this, and, you know, what does it mean? And really, I think what it comes down to is, if you're in a variable rate mortgage today, and, you know, prime is, you know, 6.95%, and you say, if I were to convert from a variable rate mortgage into a fixed rate mortgage of a term of, you know, 3 years, let's say a 3-year term.
Sure.
Right? That 3-year term rate might be somewhere around 5.34%. So immediately you're going to have interest savings.
Yes.
Coming down from 695 to 5.34.
And cash flow savings.
And cash flow savings.
Lower payment.
100%. Well. So now your cash flow has automatically been increased, which will allow you to maybe even in some cases breathe. You know, you don't feel like the debt levels are at your neck. And so you're immediately relieved of that cash flow problem. So you feel like you're winning now.
Yeah, that goes to what I was saying earlier. Like, if cash flow is the number one priority today, then maybe it is something you do today. Maybe you make the switch to fixed because you will get that immediate little bit of relief there.
But the flip side to that is by winning now and now having to lock into a 3-year term, when rates eventually, hopefully, come back down, you will potentially lose later.
Maybe not. But I think a lot of
That's the
Canadians, there's not going to be a later for a lot of Canadians if they're struggling
today. Yeah.
So take action today if you feel like it's the right move for you. If you're really struggling, and converting might lower your payment by $800 or $1,000. And that's the difference between you being able to keep your home versus you being put in a position where now, what do you do? It's scary to even think it.
Exactly.
So for a lot of people, it's like D-Day, like, or it's approaching that. Like, you need to make a decision here. What are you doing with your variable rate mortgage?
Yeah.
Are you riding this out, and can you sustain another? Because there might still be another rate hike later this year.
And I
can
still
you
think
sustain
that's
another
coming.
one? Can you sustain another one? And again, we're not economists or Nostradamus. We can't predict the future, but how long do you think you'll have to sustain it for? Right? When do you think?
Well,
based on all the information that you ingest, when do you think it's going to go down again?
Yeah, and you know, I look at it and say, at what point is it too much, right? At what point, if is it another quarter basis point? Is it another half of a percentage point that rates increase before it becomes unbearable to the consumer, to the borrower, and all of a sudden now you're locking in, and what are rates going to be then? Right? And now you have additional losses against your fixed rate of, 5.34 that we mentioned. So is now the time? Maybe it is. Maybe it's not. I don't know. But what I do know is everybody's situation is different. And I think it's time that we actually start taking a look. That's what I really think.
Yeah. I hope. Like you said something there that is now the time where you have to sort of do something. Like that time may have already passed a few rate increases ago for some people. And maybe they haven't had to do anything because their mortgage has a static payment. So they're still in variable. They haven't felt this yet because they haven't bothered to increase their payment. But that's like a storm looming over the house, right? Because that mortgage at some point is either going to be up for renewal, and then you're going to have a huge payment shock.
Exactly.
Or depending on the bank, you might reach that trigger point, and now you're going to get that phone call saying, guess what? Your payment is going to go up by $1,500 next month.
Exactly.
Good luck to you. So I worry that a lot of people have hit this point already. It's just, we haven't felt the downstream effects of it yet.
Yeah. And that's the scary part, because that would mean that there would be some very interesting times ahead.
Yeah, the unknown is the scary part. Like if you could tell people that, guys, in 12 months, we're going to be okay, then, okay, well, I can make a plan for the next 12 months. Yeah. And I can figure out my situation that puts me in the best position financially. But is it going to be 12 months? I don't know.
We don't know. It's a variable that you cannot plan around. And without that variable, it's tough to continue to do what a lot of variable rate holders are doing. So, for me, as I know I've said this before, when you're looking at making that financial decision on, fixed versus variable, it's often something that I don't believe people take enough time, energy, effort into getting to understand.
Oh my God. So maybe now it's happening more because people have been burned, but I was working for the unnamed big bank that I've previously refused to give free ads for. But when I was there, and then even when I moved into sort of like a coaching role after that, for years it was, why does your client want variable? That's the lowest rate.
the lowest
Okay.
rate. That's
But
not
what, like, you've got them at a 30-year amortization with, 2%, like, and they're super tight. Like one fluctuation, then what? It's like, yeah, that's the lowest rate. and people became complacent.
Yes.
Because rates, thankfully for these
low
people,
for a long
stayed
time.
low. So they didn't have to be put in the position that a lot of people are being put in now.
Yes.
But to your point, like, I think now, if anything, people are actually having more of these conversations because, I won't swear, holy smokes, like, look what's happened in the last year. Whereas from, I'll say, 2009 to let's say 2017, and you can even go stretch that to 2020, 2021. Why are you putting your client in the variable rate product? They don't seem to really be a variable rate type of client. Yeah, it's the lowest rate. And then you get into those positions where either you speak to them about the advice piece, the planning piece, or you get I hate to say it, you get mortgage agents that maybe aren't confident enough to have that conversation. So what are they worried about? Well, if I don't give them this variable rate, guess what? They're going to go to some other agent and they're just going to do it.
Exactly.
And, it's not the way that someone in our business should operate.
But that's the
Sadly, it
difference.
happened for a long time.
Yeah.
I'm just see what I'm doing here. I'm taking a positive out of this experience.
That's a first.
Negative Ned over here, as my wife calls me sometimes. From this experience, I hope we get back to having those conversations and people, I'm going to say, respecting the profession a little bit more, because there gets to be a point where a lot of agents, when you're doing that, I'll give you variable because it's low. What are you? You're an order taker at that point, right?
You're not actually doing the one thing that we're supposed to be doing, which is giving guidance, support, and education.
So there's the silver lining on this, that as an industry professional, I see us getting back to more advice-based conversations, more planning when we put a client into a particular product, not just saying, yeah, what'd you see online? $499. I can do $498. How's that sound?
Yeah, we're bidding.
So let's hope we go back to that model.
Yeah, where mortgages matter.
Yeah, because now more than ever, people are, I'm sure, coming to you and saying, what should I be going into at this point?
It's a whole different conversation.
It's before it used to be, what's the best rate you can get me? Whereas now it's, what should I even choose as a product here?
Yeah. What should I be buying? What should I be looking at buying? Should I be looking at single family homes? Should I be looking at multi-unit homes? It's a whole different conversation now.
But even renewals, right? So you're coming up for renewal, things are tighter than probably they've ever been. If you renewed your mortgage 3 years ago, you weren't as tight as you will be when you're renewing now. So now it's also, what else is coming up for you?
Exactly.
We're talking about a 3-year term. Do you foresee, how old's your car? How old's your furnace? Like, what else could happen over the course of this next term that could throw you into a bit of a, not to use hyperbole here, but like, what if it could throw you into a tailspin if you have a $20,000 expense over the next couple years? So we're renewing your mortgage. Here are your options. 3 years, what's your life look like over the next 2-3 years?
Yeah.
Job stability, any expenses coming, kids going to university, like hopefully, again, this disruption in our industry due to this escalating rate environment gets people back to having these planning conversations.
Yeah, I mean, I look at these types of conversations that we're now having, and I remind people that when you're buying a home and you're in the real estate market, that's one part of it, because of course you want that home to appreciate in value. You want to buy low, and if you're going to sell, you want to sell high. But the other variable is the interest rate on which the money is secured.
I'm laughing because I know we've had this conversation. You talk about appreciation, and I'm like, yeah, but you still got to afford the house.
You got to buy the house.
Like,
you got to afford it, right?
It's great to have this house, but until it appreciates,
you got to
still
afford
got
it.
to be able to make the payments.
Yeah. So, I go back to the comment I made earlier. When people are trying to decide, okay, what do I do today? It comes down to simply, if you're paying 6.95% today and you're able to get a 5.34% interest rate today, you are automatically going to be saving money, which means even if you win today and rates happen to go down 2 years from now, I don't think that's a negative decision.
Well, you've won in year 1 and 2, and in year 3,
you're gonna be down.
Yeah, maybe.
But it's just like a stock.
Are you
at
up
that
overall?
point.
Who knows?
Exactly.
But and it's easy to look at that time to say, oh, I made a foolish decision.
Yeah, I
but
could
no,
have.
you forgot the situation you were in 2 years ago, where cash flow was at a critical point. So, I always tell people, like, when they compare a 3-year, let's say, fixed to a 5-year fixed, and you're like, yeah, but I can get lower in a 5? Yes, you can.
Yes, you can.
So what does that mean? Well, all I know it means is that in years 1, 2, and 3, you're going to save more if you took the 5.
Exactly.
But year 4 and 5, you still have the same product.
But
if you took
payment,
the 3 and you had to renew, what are you renewing at? Nobody knows.
Nobody knows.
So do you take your savings in years 1, 2, and 3? Or do you take a little bit of a gamble that, I don't mind paying a little bit more interest because I think the payoff will be in year 3 when I'm now able to renew at a lower rate. But ultimately, do you have a crystal ball? Because I don't.
I mean, I don't know what I don't know. But what I do know is a fixed rate you can plan around.
I think as long as you and your mortgage professional, whoever it is that you trust, are having these conversations, you're going to make sound decisions. There are good decisions with some unfortunate outcomes. Well, for example, what we're facing now. Maybe you took a variable rate a couple of years ago. Was it a poor decision or just a poor outcome? Right.
Exactly.
And then there's the opposite as well. There's poor decisions that can be made. So as long as you're having thorough conversations and you're planning, I think you can feel pretty good, both as a mortgage professional and as a customer, that, you know what, I did my due diligence here. Now, if life throws me a curveball, if the economy throws me a curveball, so be it. But I was diligent in my planning. This is why I took what I took.
Yeah, makes sense. Well, I think we've talked that one to death.
I came in here passionate today, Clyde. When I saw that news this morning,
I know you were hot.
I had to calm down for a little bit.
But
I was upset thinking of our fellow Canadians and how this hurts people.
It does. Listen, anytime the government is taking money out of the pockets of Canadians, it's tough not to be passionate about it. But on the flip side of every coin is another option, and so we have to look at it and say which one's right for us. So with that, let's remind the people, Lou, where do they find you?
Yeah, well, so I was just going to say, any questions, doesn't have to be me. I'd love it if you all called me, but contact your trusted mortgage professional. Me, if this is going on socials, at 𝗁𝗍𝗍𝗶𝗀 MTG is my Instagram handle, and you can find me, 𝗁𝗍𝗍𝗶𝗀 on LinkedIn and Facebook and all that stuff as well. And our website, which is
uptown.ca.
Okay, perfect. Find me there. You'll see my email and the rest of our talented team as well.
Perfect. So, as always, everyone, I'm 𝗁𝗍𝗶𝗀𝗽, and thank you for listening.